Next, I want to share with you today the hidden engine behind rising markets. Now, in recent years, financial markets have defied economic headwinds. Stocks are near all-time highs, Bitcoin has surged past 100,000, and gold is flirting with record prices. Now, the reason is simple, a quiet but powerful force, which is known as money printing. Now, the US M2 money supply, which includes cash, checking, savings, and money markets deposits, has reached record highs. Now, basically, this is things that can turn into money quick, liquid cash. Okay, so it has reached record highs right now. Now, this reflects an aggressive monetary expansion by the Fed, with trillions pumped into the economy since 2020 via quantitative easing, or better known as QE, and near zero interest rates, right? As you all know, 2020 was COVID, and that was the time, this money printing press was working at full scale. Well, so when this much money floods the system, it does not sit still. It flows into financial assets. Okay. So why more money means higher asset price? At its core, this is basically simple economics. More money chasing the same number of assets leads to higher prices. With bank accounts full, investors have poured into stocks, crypto, and commodities. Interest rates near zero mean traditional savings and bonds offered poor returns, pushing even conservative investors towards riskier assets. Now, this is not a new phenomenon. After the 2008 financial crisis, a similar QE program helped launch the longest bull market in US history. But the 2020 money printing cycle was far larger and faster, inflating not just stocks, but also cryptocurrencies and gold. Okay, basically, it took like about 3 months, and this whole thing, the whole stock markets was really near right up there already, the highs. This is unprecedented, how this money printing, can work, how fast they can work. Basically, COVID, hit around February, where the market tanked, right? Towards the end of February. And then where during about nearing the end of March, you had this printing press, starting printing money around the end of March. And by, within a short time, to roughly April, by the end of April, the market has recovered about 50% of the entire drop, entire COVID drop already. And if I'm not wrong, by September, the same year of 2020, we already had a higher high than the entire COVID drop. So what does that mean? This shows this is definitely, like I said, one of the largest and the fastest ever recovery in the market. Within 1 year, we had all-time highs from that huge drop due to COVID. Okay, and not only that, we had cryptocurrencies, we had gold, all shooting higher as well. So importantly, not all of this money reaches everyday spending. Much of it flows directly into financial markets. Now, this is why asset prices can soar even when inflation appears contained in consumer goods, right? So what happens when the money spigot open? Okay, it's like a tap. Okay, spigot is like a tap. Now, the Fed tools such as QE, low rates, and regulatory easing like supplementary leverage ratio allow banks to lend more and absorb more government debt. Now, these tools were essential in stabilizing markets during crisis, but they also signal how far central banks are willing to go to keep the financial system afloat. Now, the risk is this. If something in the system breaks, such as commercial real estate or banking, more money will likely be printed at an even faster rate. We've seen that in 2008 already. History suggests that when problems emerge, policy response is to inflate our way out. So, a lesson in history: in the 1970s, heavy government spending and loose monetary policy led to a wave of inflation and a collapse in the dollar's purchasing power. Gold, then at $35 an ounce, skyrocketed to $850 by 1980. Now, the Fed eventually had to raise interest rates to cover 15%, to over 15%, sorry, to stop runaway inflation, causing a deep recession. Now, that era proved that unchecked money supply growth eventually comes with painful consequences. So, we are also in those times once again, right? And that creates the question: should investors still hold stocks? So in the short term, the current environment still favors holding stocks. Liquidity is still high, and despite weakening fundamentals like labor market softness, we talked about that in the previous report, or earnings downgrades, the market continue to rally on expectations of easier monetary policy because they know easy money will push market higher. Okay, this is a rigged game, right? So, however, investors should not assume this trend will last forever. Okay, so we can hold the stocks, but don't expect to last forever. Look out for these key signals. And this is really, to me personally, I think this is really, really crucial that everyone should take heed. Okay, now, first of all, inflation data. If inflation re-accelerates, the Fed may pause or reverse unexpected rate cuts, and reverse expected rate cuts. This would be bearish for equity. So check out the inflation. We are going to have the PCE coming in next week. So that is important data to see. Then next is the M2 growth rates. So if the Fed slows down the pace of money supply expansion, asset prices may stagnate or correct. Next, we have the credit market. Watch bank lendings and credit conditions. A tightening cycle or credit stress may lead to a sharp sell-off. And lastly, corporate earnings. I think this you can watch it out from a quarter-to-quarter basis. So if earnings fails to grow, while valuations remain high, corrections risk increases. So a prudent investor may consider continuing to hold stocks with a selective focus on sectors that benefit from inflation or pricing power, such as energy, industrials, or defense. And also defensive sectors like healthcare and consumer staples can also provide shelter during volatility. Okay, so you notice what kind of stocks that I am focusing already right now, right? So anyway, when it comes to the stock area, you shall see the one that we chose. Now, is it safe to keep buying the US dollars? I think that is another important question. So while the US dollar remains the world's dominant reserve currency, its long-term purchasing power is under pressure, right? Massive fiscal deficits, continued monetary expansion, and weakening global confidence in US debt have all contributed to the dollar's recent losses. Now, holding a large amount of cash in US dollars during high money supply growth is risky, especially with interest rates expected to decline. So if you are thinking long term, blindly buying and holding US dollars is not the safest strategy. You are essentially trading short-term stability for long-term erosion of value. So where should investors move the cash then? Okay, if not the US dollars, where shall they put? Okay, other than stocks. So if the goal is to preserve purchasing power and hedge against further dollar weakness or inflation, consider the following. First of all, gold and silver, historically resilient in inflationary environments and during monetary debasement. Next is the Treasury inflation protected securities, better known as TIPS, which are bonds that adjust payouts based on inflation. Now, commodities, ETF, or real assets. Okay, agriculture, commodities, energy, all materials can outperform during dollar weaknesses. Okay. Now, next is the foreign currencies or bonds. Some investors diversify into stable or appreciating currencies like the Swiss franc, the Singapore dollar, or the Norwegian kroner. Okay. And finally, Bitcoin and digital assets. While volatile, they have attracted inflows as long-term hedges against fiat currency dilution. So the key is that diversification remains critical. No single asset class is foolproof. The goal is not to abandon the dollar entirely, but to reduce overexposure to a currency that is being actively debased. So as a takeaway, the markets are rising on liquidity, not fundamentals. In such an environment, holding too much cash can be risky as inflation silently eats away its value. Investors should understand that this is a policy-driven rally. What the Fed giveth, it can also taketh away. So continue to hold stocks, but stay alert to shift in policy and inflation data. Reduce cash-heavy positions and consider diversifying into assets that retain value when the dollar weakens. So lastly, prepare for volatility and remember, when the money printer runs hot, asset prices rise, but long-term confidence in cash quietly melts away. Okay, so hopefully you have a better understanding about the Q2 at this current moment, what's happening. So that's the reason why, the expectation of the money printing is keeping a lot of investors believing that this move that we have seen has another leg up. Okay, and we have also been expecting this to come as well. That's also the reason why Bitcoin is still expected to rise, because if you put the M2 side by side with the M2 growth, the world M2 growth side by side with Bitcoin, you can actually see the trajectory of the Bitcoin is more or less following the trajectory of the M2 money supply, the global M2 money supply. And that's where most of the experienced traders used to use this as a basis to what do you call plan all the necessary investments with all the different asset classes. Okay, so with that, that's the fundamental report for today. Let's move on to the chart.